February 2026. In downtown New York, an $800 million glass tower is standing completely empty. A few years ago, thousands of people worked there every day. Today, the lights are off and the offices are silent. The owner recently handed the keys back to the bank because he could no longer afford the loan. But this is not just the story of one building. Across America, nearly $1.5 trillion in commercial real estate loans are about to come due, and many experts warn that when this wave hits, it could shake the economy in a way that makes the 2008 crisis look small. Before 2020, commercial real estate was considered one of the safest investments in America. Pension funds, insurance companies, and universities had billions of dollars invested in office buildings. The reason was simple. Large companies signed long-term leases, usually for 10 to 15 years, which meant landlords received stable rent every month. At the same time, property values continued to rise. Cities like New York, San Francisco, Chicago, and Los Angeles had office occupancy rates above 90%. Downtown buildings were full of workers every day, and banks were happy to lend money because these properties looked like very safe investments. But everything changed in March 2020 when the COVID-19 pandemic began. Offices closed almost overnight, and millions of employees started working from home. At first, most companies believed this would only last a few months. But when 2021 and 2022 arrived, something surprising happened. Many employees did not want to return to the office. Companies also discovered that remote work could still be productive and much cheaper. Major tech companies started changing their policies. Microsoft allowed permanent remote work. Google adopted a hybrid model. Apple gave employees more flexibility. Slowly, many industries began doing the same thing. As office leases started expiring in 2022 and 2023, companies reduced their office space dramatically. Some moved from huge offices to much smaller ones, while others went fully remote. By 2024, the impact was clear. Office occupancy in New York dropped to about 47%. San Francisco fell even lower. And by 2026, many downtown office towers across America still have empty floors with no tenants returning. However, empty offices are only part of the problem. The real danger comes from the loans used to buy these buildings. Between 2019 and 2021, interest rates were extremely low. Borrowing money was very cheap, so developers used large loans to purchase expensive office towers. Imagine a developer buying a Manhattan office building for $500 million in 2020. He invests $100 million of his own money and borrows the remaining $400 million from a bank. But these loans usually last only 5 to 7 years. After that, the owner must refinance the loan with a new one. And this is where the problem begins. Since 2022, interest rates have risen dramatically as the Federal Reserve tried to control inflation. Loans that once had interest rates near 3% may now cost 7 or 8%. At the same time, the building itself may have lost value because many offices are now empty. This means the owner must either bring in a large amount of new cash or accept a much smaller loan. Many developers simply cannot afford this. As a result, some are defaulting on their loans and giving their buildings back to the banks. According to industry estimates, about $1.5 trillion in commercial real estate loans will come due between 2024 and 2027. Analysts warn that a large portion of these loans could face serious refinancing problems, which may trigger a wave of defaults across the country. The most serious concern is what happens next. When large numbers of loans begin to fail, the impact does not stay limited to property owners. The first institutions that may feel pressure are regional banks. Thousands of small and medium-sized banks in the United States have a large share of their loan portfolios connected to commercial real estate. If many of these loans go bad at the same time, those banks could face major financial stress. The effects could then spread even further. Pension funds, which manage retirement savings for millions of workers, also have large investments in real estate. If property values fall significantly, those funds may suffer losses that affect future retirement payments. Cities may also struggle because property taxes from office buildings are a major part of their budgets. When downtown buildings sit empty, tax revenue falls and local governments have less money for public services. Entire neighborhoods can feel the impact. Restaurants, cafes, gyms, and small businesses around office districts depend on daily office workers. When those workers stop coming, many of these businesses lose customers and are forced to close. This is why some economists describe the commercial real estate problem as a slow-moving financial crisis. But history also shows that every economic crisis creates opportunities for people who are prepared. Those who manage their money carefully, stay informed, and adapt to change often survive difficult periods much better than others. Right now it is February 2026, and the next 18 months will be critical as more loans reach their deadlines. Only then will we truly see whether this becomes a limited problem for the real estate industry or a much larger financial shock for the entire economy.